On the HSBC PMI, this is going to be the first look into the second quarter. Do you think growth will be slower than forecast like in the last quarter?
Well, these growth numbers are taking the market by surprise to the extent we are missing expectations. I think the market's having to come round to the view that not only is there a slowdown in global demand and an implicit tightening in monetary policy, but there's also a structural slowdown underway. And obviously this was not so much hinted at, but stated quite openly by the governor of the PBOC over the weekend. And it's something the market's having to come to terms with. A slower China, the implications on commodity prices, the implications on emerging market risk versus developed market, for example. So I do think that this structural slowdown is underway and will continue to surprise and disappoint the market going forward.
How does that weigh into the drop of commodity prices?
Well, look, there is a slowdown in global trade. The data does show us that, and coupled with a slowdown in China, obviously it starts to have a meaningful impact on commodities in general and, for example, industrial metals in particular. So I don't think we should be too surprised about the slowdown in demand, particularly for metals. I think it's likely to continue, frankly, and until we start to see, for example, a meaningful consolidation or bottoming in China's growth trajectory, it's likely to continue.
What are you advising clients now with their asset allocations as commodities prices continue to fall and affect risk appetite for equities?
Well, we're pretty focused on developed markets at the moment. We're overweight, for example, US equities, European equities, in particular Japanese equities. We're entirely underweight developed market sovereign risk for the risk reward. So we're pretty focused on the developed market equity story, not least their valuations, which we consider pretty compelling.
What can we expect from this earnings season?
Earnings revisions do seem to be improving somewhat in developed markets. The beat, for example, in the S&P, for those that we've seen, it's not many, but it's certainly above long-run averages. So the market is getting somewhat more positive looking forward. It's fair to say that we have had some big misses, Caterpillar obviously last night being one of them, but I think the market's looking at Q2 with a slightly more positive frame of mind and mindset, for example, than it has in the first quarter.
What about the earnings season for emerging markets?
EM is looking slightly more depressed, to be fair, and obviously this reflects the slowdown in the macro story, among other things. We are seeing, for example, pretty poor to negative year-on-year EPS growth for Asian markets, and we're seeing really a majority of them missing expectations. So I don't think there's any surprise there that that outflow of liquidity from emerging markets to developed markets seeking better growth and earnings opportunity likely to continue.